Hello everybody, hope you're doing great today. In today's video I'm going to look at the various real estate markets in the United States to talk about the ones that are seeing a downturn in pricing. So as I've mentioned in the past, I believe we are in a housing bubble. Prices have gone up quite a bit, quite fast. So with mortgage rates being at recent highs, a lot of buyers have stepped back. They're not buying houses, they've stopped their house shopping, and sellers at the same time too have also stepped back. So there is a shortage of inventory on one side. There's also a shortage of buyers. So markets will vary. It's a location by location basis. And as a personal anecdotal case, I've been taking around some out-of-town buyers. They've been wanting to see some properties in my area. And out of the 15 that we scheduled to see within 2 days, at least 6 to 7 of them went pending before they could even get into town to see those houses. So activity is still happening if the house is priced right. If it's in a neighborhood that's desired by buyers, then there are multiple offers and houses are going pending quick. On the other side, if the house is not priced good, if it needs updates, there's other issues, and it's been priced higher than it should be, then those houses are sitting on the market and not getting any offers from buyers. So let's take a look at the S&P Case-Shiller U.S. National Home Price Index. Now this index is lagging. It's lagging by a couple of months, but it still gives us an idea. It shows us the trends that are going on in the housing market. So this is based on the US as a whole, and as you can see, we hit a peak here in June 2020, and then home pricing values have started to trend downwards. So as of January 2023, we can see we've got a bit of a dip from the June 2022 peak. So this represents the US as a whole. Let's take a look at individual markets and see how their pricing is faring. Here, for example, is Atlanta. We also see August 2022, the peak, and it's starting to drop down. Los Angeles as well, it has a peak here in May 2022. It's got a steeper drop down. Similar to Los Angeles, we've got Seattle, the peak over here in May 2022. Also a steep decline in the next couple of months. Similarly, Phoenix, Arizona, June 2022 peak and a steep decline over the next couple of months. Boston here is a little different. We've got a peak here in July 2022, drop down, and then it started to pick back up a little bit in January 2023. But as we can see, the pricing is still below that peak. Chicago had a modest peak in July 2022, and it's also a modest leveling off. It's not as steep as some of the other markets we just looked at. Similarly with Dallas, June 2022 peak, and we've got more of a steep decline. Miami, we've got a July 2022 peak, slight drop, and it kind of levels off. So not too bad of a case in Miami. Similarly with New York here, we've got a peak in June 2022 and a modest decline over the next couple of months. So as you can see, some markets like Los Angeles, Seattle, San Francisco have seen steep declines over the past few months. Some of that can be traced to people leaving those high cost of living areas, especially those who are in a work from home status, who are able to work from home, don't need to go into an office. A lot of those big cities like Seattle, like Los Angeles, they have a lot of employers over there, the high tech companies. So a lot of those employees who are now in work from home status decided to move to low cost of living areas. Now if layoffs increase and these companies cancel their work from home policies, forcing people to come back in, you might just see people not wanting to come back to those areas, stick in their own areas and just look for different jobs. So overall, we're still early in this market change for real estate. These bubbles do not deflate overnight. They can take years at a time. In the past correction, in the 2007, 2008 timeframe, it took a number of years, 3-4 years before the prices seen their bottom in the drop from the top of the bubble. So the previous bubble we had here in February 2007, we can see the peak, and then about 5 years later, we see the bottom of that bubble as it deflated. So the peak here is February 2007, and then over the next 5 years, the bottoming out of that bubble was January 2012. So similarly with today's bubble, it's going to take a number of years for this to play out. Assuming interest rates stay high, there's no other shock to the market, it'll take time to work itself out. Now if there's some sort of shock to the market, something else, some geopolitical thing, war in Taiwan, war somewhere else in the world, layoffs increase, mortgage rates stay high, then that's definitely going to put a lot of pressure on the housing market, and we might see it drop faster. So what do we know that the average consumer doesn't know? A lot of the average consumer, due to inadequate financial education in the schooling systems. They don't even know what the Federal Reserve is. They don't know how federal funds rate are set. So they're kind of looking at this from a neutral perspective. The only thing they are seeing is that mortgage rates are going up. They don't understand why mortgage rates are going up. They don't know about the process of mortgage-backed securities, when the Federal Reserve started buying those securities, and how that impacts the mortgage interest rate. So for those of us who are a little more in the know, we understand that rates are up, the economy is kind of on shaky grounds, there's some geopolitical aspects going on there that could throw everything upside down. So the question becomes, should we buy real estate? Should we buy a home? Should we buy investment property? Does it make sense to do that now? With regards to investment real estate, it might make sense to do that if you can find the right investment at the right price. Does the cap rate numbers make sense? Are you going to be cash flowing? You don't have to put a lot of cash up front in order to get that property to where it needs to be. Then yes, it might be a good deal to buy. You also need to consider locations, city centers, even suburban centers where people congregate to shop. Some of those investments will be better. They'll stand the test of time. People always need their local businesses, whether it's grocery stores, liquor stores, local restaurants, local services. Those types of businesses will always be in demand. Whether the current business survives or not, we need to ultimately know, can we get somebody else in there if a business fails to fill that vacancy? So for example, in a strip mall, usually your pizza chains are going to be fine. Even your small independent pizza places, assuming little competition in and around the area, they're going to survive. People are always going to be buying pizza. With the liquor stores as well, people are always going to be purchasing alcohol. While they may trade down in price, if economic conditions go down, people are always going to be buying. So things like that stand the test of time. And if you have investment property, such as a strip mall that has that type of business in there, you should be able to withstand a recession. For those looking to buy a home to live in, you need to look at what's your time frame on buying a home. If you're moving to a new area, you know you're only going to be there for 2 to 3 years. It might not make sense to buy a home. Renting might make more sense, especially if you know you're going to the West Coast, you live in the East Coast, and you're only going to be there a couple of years for work. No need to purchase a house. There's a lot of transaction costs involved, especially if you're getting a mortgage. You've got real estate commissions, taxes, and whatnot. Those are not necessarily going to be recovered over a couple of years, especially if prices remain flat or actually go down. Now, if you plan on being in a house for a long time, you know you want to move to a new house, you live in an apartment now, you're expanding your family, whatever your situation is, you're going to buy a house, you know you're going to be staying there for at least 10 years or more, then it might make sense to purchase a home even with today's mortgage rates. The one thing to do when considering the purchase of a home is look at the price, look at the current mortgage rates, and determine what your monthly payment is. Does that fit with your budget? Don't stretch for that budget. These days, 30% of income going to housing costs is seen as the limit. Some people stretch it to 40%. My advice is, if you're able to find a house that is within the 20 to 30% range, closer to the 20% range, it's better. Find a house that fits within your budget, that meets your needs. There's no need to go out and overbuy a house that's going to put you in a house poor situation. Houses need a lot of maintenance. You need to keep up on regular maintenance. If you miss out on maintenance or you can't afford to do the maintenance, that house over time is going to degrade, especially when it comes to things like roof leaks, plumbing leaks. Putting a band-aid on those types of repairs might be a quick fix, but over the long term, as those leaks continue on, that's going to cause further damage to the house. That'll cause mold to get into the house. Ultimately, it's going to make your house unlivable, in which case whatever money you put into that house as a down payment is out the window. You've lost it all. So buy a house that you can afford, buy a house that fits within your budget, and if you're going to be there for a number of years, that house is going to be fine for you. You've got time to make updates and upgrades to it over time. That way it retains its value. That's all I have for this video. Please hit that like button to let me know if this video was helpful to you. Thank you for watching, and I will see you in the next video.